Your trade. All right, I want to get back to Jim Rogers, who joins us, as you see, of course, from Paris, France, which is appropriate given we're talking about Europe. And Jim, if we do ultimately see this default we have so often talked about in Greece and turmoil of some type ensues, where, as a global investor, do you want to be?
Well, first, I just want to say quickly, I own some euros, so I'm not talking that I hope this. I'll lose money if it happens. It'll be good for the world, though, if it did happen, if they let people go bankrupt. My portfolio, David, I own commodities, especially precious metals and agriculture, and I own some currencies. I'm short stocks. I'm short stocks in Europe. I'm short stocks in America, and I'm shorts in emerging markets. Who knows if I'm right?
You're long commodities, but you're short stocks. Explain how this fits in with the global growth story, or is there a global growth story, and why are you long commodities, but wouldn't you still be long some commodity stocks, for example?
No, well, I have some left over from 15 years ago. No, if the world economy gets better, I'm going to make money in commodities because of shortages that are developing, especially in agriculture and precious metals. If the world economy doesn't get better, Bob, you're not going to make any money in Toyota or IBM, but you might make money in commodities because they're going to print more money. It's the wrong thing to do, but they will print money. Bernanke is already printing money again. So you have to protect yourself. So I'm short stocks because I don't expect the world economy to get better, not much better anyway if it does. And I'm long commodities as a protection.
He's already, you said Bernanke is already printing money. Has a new program been announced?
No, but I mean, that brings us to the U.S. dollar, of course, Jim, which today is stronger against the euro. I would assume, though, that your long-term forecast for the dollar is not a particularly positive one.
The long-term forecast for the U.S. dollar is disaster, catastrophe. Having said that, as I've said on CNBC several times in the past few months, I'm long the U.S. dollar. And the only reason I'm long, David, is because everybody in the world, including me, has been terribly pessimistic. And whenever that happens, you should take the other side of the trade. So I'm long the U.S. dollar. I have no confidence in it. It's going to be a disaster. But as we speak, I own probably more U.S. dollars than I've owned in many years, and certainly more than most other currencies.
So you're bullish
but
the dollars.
Bob, to your point.
Go ahead, Jim.
To your point, Bob, Bernanke's been lying to us again. He announced in early August that he was going to keep interest rates at a very low rate for 2 years. Now, Bob, how's he going to do that? You can't just say the words. You have to go into the market and force interest rates down. I mean, come on, what is this? You believe in the tooth fairy? He's in there. That's the only way he can do it. And if you don't believe the theory of how monetary policy works, get out the unadjusted M2 numbers since the beginning of August, and you will see they shot up starting at the beginning of August as soon as he said, we're going to keep interest rates down. So he's in the market. He may be lying to us. They usually do. But he's in there. Be prepared.
We see the 10-year, of course, at 1.91%. That really is somewhat shocking to look at. You know, talking about intervention in markets, Jim, the week began with the Swiss coming in to try to say, hey, you know, stop overvaluing our currency against the euro. You think that's going to work out?
No, of course it's not. Of course it's not. No central bank in the world has ever been able to control its currency in the long run. Many countries have tried, David, but the market always has more. The British tried it 15 or 20 years ago. Everybody's tried it. But in the end, the market has more money. The Swiss will have two things happen. One, they will drive the currency down so much that they will no longer be a financial center, or it'll go up again, and they'll lose money on all the currencies they're buying. So this is a terrible mistake. The way you sort things out is you let the market take its course. The cure for high prices is high prices. That's how you sort things out.
Jim, give us a couple thoughts on the global economy right now. China came out with their inflation numbers this morning, appear to be a little bit under control. Chinese will probably not be hiking interest rates anytime soon. GDP not as strong as it was maybe a year ago, but still looking pretty good. What's your thoughts here?
China is trying to slow its economy down. They've raised interest rates 6 times. I wish America had raised its rates 6 times. They've raised reserve requirements 12 times. They're trying to slow things down. India, the same way. Many countries in the world acknowledge that, Australia, many countries acknowledge inflation, and they're trying to slow things down. That's one reason I'm not so wildly optimistic about the world economy going forward.
Jim, as always, a pleasure to hear your thoughts. Thank you for joining us. Wish I could join you for a drink in the late afternoon there, but I'm sure you will enjoy yourself. Jim Rogers from Paris, France.